Good evening, ladies and gentlemen. Can I welcome you to the South Yorkshire Pensions Authority Annual Fund Meeting for 2016 and to the Holiday Inn here at Dodderth, as they say in these here parts. I'm not Frances Foster. Frances sends her apologies this evening. She can't be here. My name is Martin McCarthy. I'm Deputy Clerk to the Pensions Authority. Just a few housekeeping issues really before we get started. There's no fire alarm expected this evening, so if the alarm does sound, we will need to evacuate through the way you've come in this evening. And we'll congregate in the car park at the front of the hotel, if that's okay for everyone. And if those of you who haven't needed the toilet, if you need the toilet, it's out of the door that you've come in, and if you turn right, the toilets are down there on the, I think it's the left-hand right, on the right. I do apologise. Okay, I'm now, that's all I need to say. I've done my bit. That's great for this evening. I might just interfere a bit if we're asking any questions a little bit later. But if I could introduce the panel here. Councillor Sue Ellis, who is Chair of the Pensions Authority. They'll introduce themselves when they get up to speak. Steve Barrett, who is our Interim Fund Director, and Gary Chapman, who is Head of Pensions Administration. And very shortly, Councillor Mick Stowe, who is the Vice Chair to the Authority, will no doubt be coming through that door a little bit out of breath. So I'm going to hand you over. Oh, timing. Never ever happens to me, that timing. Perfect. Hi, Mick. I'm going to hand you over now to Councillor Sue Ellis, the Chair of the Pensions Authority. Thank you.
Right, good evening, everybody. Again, a very warm welcome to here in Barnsley. It is the home of South Yorkshire Pensions, just down the road, 10 minutes at Regent Street. Martin has already messed up because I was going to do the introduction, so that's the first bit off me script. Although I would like to say a little bit about the people to my right. You'll notice here is Steve Barrett. He is the interim director of the fund, and he has replaced John Hattersley, who anybody who's been to this or seen it screened will remember John. He retired this year. We had wanted to pay tribute to him today in front of you all. He's a mild-mannered man. He doesn't like fuss. He wouldn't come for that. But it would be remiss of me if I didn't pay tribute to him. His skills and his knowledge about pensions and the investment world are really unsurpassed, and we really will miss him. He did spend 42 years in public service, so I think he does actually deserve a long and happy retirement, and we wish him that. I'd like to say, though, his skills and his knowledge weren't just to our benefit. They were, in fact, nationally acknowledged, and that was rightly so. But, and I've said this before, John was a mild-mannered man, but he shared his skills not only with me as a new chair last year, but with all his staff. And maybe his lasting legacy, of course, is that the South Yorkshire Pension Funds is in a very good position. It has staff unsurpassed in their skills and knowledge, but also in their loyalty and hard work, which have been put to the test this last year, because the investment team have had all the extra work that the pooling arrangements have come, and Steve will talk about that later, and the administration side under Gary, and he will talk about this, have had the trials and tribulations still of the new technology, and without our staff we would not be in the good position that we're in. So when you hear about it, I would like you to think about those staff that have put the members, you and me, first in all that they do. And that has been very much something that John has instilled in them over all that years, that attitude to the fund. So and if he's watching tonight, although why he will be, I don't know, we wish you well, John, and we really hope you have a happy retirement. You will have guessed by that comment that we are being live streamed. It was a suggestion from this meeting a couple of years ago. I think it's important that we are open and transparent, and this is a way that members who can't be here tonight can see what we're saying and what we're doing at this moment in time. It is important to me, this meeting. I think it is right and proper that we are here to report to you what we've done in the last year, and to explain it and take your questions. We do hold this meeting in high regard, and think it's important. So thank you as well for coming. How we're going to do the rest of the evening is Steve will say something and have a presentation followed by Gary, and then we usually do, for a bit of fun, the quiz. Last year we actually ran out of time, and so we'll maybe put it to the vote at the end of the evening whether you want the quiz or whether you want to get on with that and have a sandwich. So we'll come back to that later. I think that's all from me at the moment. We'll speak to you at the end of the meeting just about questionnaires and feedback, but over to Steve Barrett, our interim fund director.
Right, good evening. Can everybody hear me all right? Good. Well, thanks very much for coming tonight, and it's a pleasure to be here. I pay my own tribute to John Hattersley. I thought he might come and sit at the back and ask really hard questions, so he's obviously been kind enough not to do that. So what I want to do tonight is run through quite a few slides, I'm afraid, but I think you've got copies of them anyway, because I'm going to try and cover how the fund is doing, and as the chair's already said, it's in a good state. It's been a well-run fund for a number of years and still doing very well. But I also touch on the actuarial update, because this is the time of the year when, well, it's the time when we're looking at the 3-year or the triennial valuation results for the year ended 31st of March 16. So that gives us a measure of how the fund is doing too. And then we look at these new arrangements about pooling investment funds that have come in the last few years as an idea and is moving forward at pace now. So firstly, yeah, all right? Am I still on? Yeah. Right, so this first slide is looking at a picture of, you want me to use that now? Is that better? Okay, so this first slide is looking at a view of the valuation of the fund at 6.22 millions at the end of 31st of March 16, which is broadly where it was this time last year. And you can see in terms of the split between the different asset allocations, between the black bar and the reddish bar or the pink bar, how things have moved. There's not a great deal of movement, but there are some areas which have moved up and some areas which have moved down a little, which we'll look at in a little bit more, a different view. Oops, jumping ahead a bit too quick. In terms of how the fund has performed in its investment returns, the thing that is most noticeable on the slide is that the 1-year return in the first column looks pretty small numbers compared to the returns that we had over 3 years, 5 years and 10 years. But the important thing to bear in mind here is how the fund is doing against its benchmark, the black bar in the middle, and against consumer price inflation, which is the sort of bluish bar. What happened in the year ended 31st of March 16 is that the fund's actually overperformed its benchmark, not by a fantastic amount, but 0.5% return compared to a 0.1% return. Doesn't sound like a lot, but when you consider that that's better than the average local authority fund performance of 0.2% returns, we haven't done that badly. It's because returns for the year were flat in general. The economy, the position the economy was in, globally and in the UK, there were very little returns coming in from the equity markets generally, and they were all negative in effect apart from North America. So while performance is down for the fund, its relative position compared to everybody else was still quite reasonable. Just have a little look again. Oops, this is jumping, that's it. If we have a look at the asset allocation as at the end of March 16, what this slide is showing you really is how the fund is split out in a little bit more detail or a bit more clarity. It's the same information in effect in the first column or on the chart as was in the first slide. It's just giving you it in a pie chart formation. And I think the things to bear in mind there are, what it's telling you is that at the year end, as against our middle column general fund benchmark, where we generally look to allocate assets, you can see that we were a bit underweight in UK equities, a little bit overweight in international equities, a little bit underweight in fixed interest, and a little bit overweight in private equity, alternative income, and in property. And that reflects, if you like, the view of where investments felt they would make a return, in more overweight in international equities, less in the UK, and being more overweight in, if you like, slightly higher risk assets where we would get more of a growth return. So private equity and alternative income and property. They are less liquid, they are longer term investments. There's a bit more risk to it, but you generally get a better return over the longer term. And I'll be saying a little bit more at the end of the evening about the need for the fund to keep a focus on its objectives, its liability profile, and getting its balance right on the asset allocation as between growth assets, income assets, and those things that we use to protect, if you like, the liabilities of the fund, which are really investments in fixed interest. It's going too quickly. Right, that's just showing you a little bit more granularity about what the split is between the international equities and UK equities. You can see that there's obviously much heavier weighting to international. Oops, this is just jumping around a bit too quickly for me. Apologies for the slide control. Gary's going to do a better job once I've warmed this up. Right, I'll just pause on the international equity asset allocation. There is a question later on about other countries. I think the Canada Teachers Pension Fund is one of the questions we've had. What, they're investing in the UK. Well, we invest internationally as well, of course, as you can see. And this chart just gives you that in a graphic format. 40.7% of the fund's about 6 billion. That's of our 6 billion fund is about 2.5 billion, which is allocated over equities overseas. And what the chart doesn't tell you specifically, but we are weighting more to emerging markets within that slide, North America and emerging markets, where we think over the future they're likely to be stronger returns. Again, going too quickly. Right, that's where we should be. Fixed interest split. Again, when I talked about growth investments, income and investments, and protection investments, the first one there, UK index linked, you can see that within the fixed interest element of the fund, we've got more than half of it in UK index linked bonds. And that's because all pension funds look to try to have an element which protects gives them a match against the liabilities, the pensions that we have to pay. And bonds are good because they produce an income stream over time, which matches the liability stream of pensions that we have to pay over time. We also use some areas which give us a little bit more risk, but give you a bit of a higher yield potentially. So we've got 6.9% in high yield bonds and 13% in emerging market bonds. The corporate bonds there, we use an external partner, Royal London, to manage a portfolio there. which you might have heard about last year. It was a relatively new development last year, and that's doing reasonably well. But the fund continues to favour at the moment the more risk assets too, because we need to try and grow the value of the fund. And the reason for that, favouring the risk assets rather than fixed interest, is because at the moment, well, not at the moment, you'll have seen a slide like that in previous years, the kind of yield that we're getting now on bonds, government bonds, whichever country they're in really. These are UK government index-linked yields. You can see they're quite low really. So there's not a massive reason to want to invest in those just at the moment for that reason, and therefore we're a little bit underweight in those areas and a bit more overweight on, if you like, growth assets. If I move on to property, this just gives you a picture of a bit of an example of we have about well, at the moment it's, well, at this point in time it's about 700 million invested in property, about 420 millions with spread across commercial properties, of which these are 3 examples of what we invest in. We look for investments in good locations, in good sectors, and in quality properties. So we've got one here which is an office complex in Guildford, getting a very good market rental income stream. We've got a retail warehouse in Grantham. Again, it's well let and gets a good rental stream. And another one is Oxgate, Staples Corner, London, which is a sort of industrial site. And those give us a good income stream. Again, I talked about growth assets, income assets, and protection assets. So property did quite well at the end of 31st of March 16, but again, for a second year in a row, we didn't do so well on our agricultural property portfolio, and we have some European property funds which didn't perform as well. But overall, the property portfolio brought a good return. Oops. That's ruined my joke. Right. Come on. And get back to this. There we go. Right. So we're on fund valuation at the 31st of March 16. Now, you can see the picture there of how the fund has grown over the years. You can see what happened in 2000. I'm sure you've heard this before. If you look at the 2009 year, a big drop in values. That was obviously following on from the 2008 economic crash. Everything went rock bottom. Then we've built back up again. And you can see that there's not much change between 2015 and 2016. That's the reason that I was saying earlier on about fairly flat year, negative equity returns across most of the world. So at the 31st of March 16, though, the fund held up at 6.2 billion, and it's moved to 7 billion at the 31st of August 16. Well, why? Well, some element of that, frankly, is just the devaluation of sterling and the effect it has on increasing the value of overseas assets. So that's a kind of a, if you like, partly a Brexit effect, which we'll no doubt talk about later in questions. But overall, the message is that the fund is increasing relatively steadily in value. That's it in terms of fund performance, except I just want to mention about the actuarial valuation. So these are provisional figures. They're not confirmed yet, but every 3 years as a valuation exercise, the actuaries have a look at the assets that we've got. You can see in that right-hand column that we're talking about a fund value at the 31st of March of about £6.2 billion. Our liabilities, however, they tend to rise anyway over time, but the deficit is coming down because employee contributions, and likely income earnings over the future are a little bit more positive, and so our funding levels increasing from 76 to 85% provisionally. So that's a good process. We're well underway in discussing things with the actuary and discussing the implications of that with the major employers in the area. I think there are positives to take nationally that the local government pension scheme is a success story insofar as it's now actually holding more assets per pound of liability than it's ever held before. And deficits are generally not getting any worse, and in most cases getting better in their funding levels, as is the case for our fund. So I was going to move on to pooling now, but I was just going to end off on the fact that we have had a few questions around Brexit, and I couldn't resist touching on what was happening this time last Thursday, I think, in particular, and at the weekend. The media had a field day with stories around Brexit linked to the Unilever Tesco story. If you heard all of that, you'll get the next slide. If you didn't, it won't mean anything to you. I've summed it was not quite an Armageddon, but more of a Marmageddon. So, apologies for that. Just a bit of lightheartedness. If I could have got the slides to work properly, it might have been a bit more effective. Right? So. Okay. So pooling. Right. Well, I think the first thing to say is what I hope you already know. The local government pension scheme, certainly in my opinion, is a world-class pension scheme. And any of these proposals we're now going to talk about should have no impact on people's pensions. They'll be paid on time and in full. What the pooling proposals are talking about, or what government hopes will be a better way of doing things, making efficiency savings and substantial efficiency savings across the country of over 200 to 300 million per year. So what the government asked for, well, back in, at least as far back as October 2015, George Osborne, when he was Chancellor, talked about creating half a dozen British wealth funds, and this has been referred to in the press. I mean, I'm sure some of you will have picked all of that up. And part of the intention was to create the opportunity to invest more in infrastructure projects as well. And proposals were asked to be submitted final proposals by July 2016. And the criteria was more or less what's up on the slide there, so I won't run through that. It speaks for itself. So initial submissions were put in, not 6, but at this stage we're looking at 8 sets of proposals were put in across the country. And they've got these different names, I'm afraid. That's just what they've been called. So access is, for example, down south, Cambridgeshire and those sorts of areas. London, well, that speaks for itself. Brunel is, Isambard, Kingdom Brunel, the bridge down in Bristol, it's that area. Central is the Midlands area. Northern is Greater Manchester and areas around there. LPP is another London one, and we're in the Borders to Coast Pension Partnership. And then Wales had a bid for 8 funds. So if we look at the next slide, the red on there tells you what's in the Borders to Coast. So you can see who's in there with us. It's mainly all the northern pension funds in the same sort of contiguous boundary area, but there were a few down south who were interested in sort of being in with a scheme like ours, which has quite a lot of internal fund management in it. Well, we have a lot of internal management in South Yorkshire. We also have it in Teesside and in the East Riding. So there's a core of competent, skilled investment managers who can come together in running that larger pool. And the 3 down south, I think there were Warwickshire, Bedfordshire and Surrey who were interested in joining in. So that's who's in the mix. And the aims of pooling, as I said earlier, in short, are scale efficiencies by bringing things together. We're only talking about bringing together the investment side of the pool, not all the administrative side, the work that Gary does, for example, it's the investment sides. But it has to provide, each fund will still have its own identity. The South Yorkshire Pension Fund, the authority, that will still continue to exist and operate and have its own interest in setting its own asset allocation and be very interested in how well the pool performs on its behalf. So we will still have an ongoing interest in what happens with the South Yorkshire Pension Fund. Oops. I've probably got a bit ahead of myself because that explained in some of the next slides. Have I jumped too far ahead there? Yeah. So that just runs through some of the benefits of scale of bringing together 12 funds to produce sort of 35, 36 billion under management rather than our 6 to 7 billion. They should achieve cost reduction by being able to have lower fees to the extent that any external fund managers are used. There should be scope to rationalise external managers and collaborate, getting, again, lower fees. On the other hand, there is no actual proof that just by being larger, you will get better investment returns per se. That's not been a factor of weighing up the value for money for these things at this point. There are some significant setup costs, but there is the expectation that they'll be recovered in over 3 to 10 years. There is scope to make further savings if funds choose to use more internal managers and again use less external managers and less fees. And they certainly should have benefits of more investment capability and resilience of an internal team than you can get in say, a 7 billion fund. So that's the argument for it, I suppose. That's just a reminder of who's in there. And you can see that we're talking about 36 billions representing all of those members and employers. Pardon me? Okay, thank you. Right. And we're talking in terms of 12 funds for simplicity's sake, because there are 12 main funds, but we shouldn't forget that there really is a 13th in there as well, and that's the South Yorkshire Passenger Transport Fund. We talk about 12 because going forward there'll be 12 main partners rather than 13. We went for that because if we'd gone for 13, i.e. 2 from South Yorkshire, we'd have had to pay 2 lots of the share of all of the setup costs and what have you, and we wanted to avoid all of that. So we've gone for efficiency. I'm not sure that one's any better. Right. So, investment decision making. The point here is that whilst the fund will be pooled under these proposals, the key asset allocation decisions still stay with the authority for the South Yorkshire Pension Fund. And it's more the operating decisions at executive level that will move to the pool itself, which will require its own management structure, regulated under the Financial Conduct Authority. So there's more, if you like, regulatory issues involved. It's a lot more complicated to run something like that because it's running it for 12 funds, not just one. So it's caught by a different regulatory environment. Oops. Again, right, I think that's where I should be. So there's still a need for appropriate local government supervision and control over this and over the fund. But the pool itself will need to be kept under governance through local elected members too. So there's likely to be a joint committee with 1 member representative from each of the 12 different funds, appropriately supported by officers and other advisors. And we expect the operating company, this pool, will have an operating company of officers who will be reporting into the joint committee, particularly around issues of performance. That's about holding the pools to account. So South Yorkshire will be particularly interested in understanding what kind of investment reporting to get back and how well the pool is performing on our behalf. Just getting towards the end there. Implementation timetable was 1st of April 2018. That might sound like quite a long way away. It's really no time at all to manage something as big as this. It's quite uncharted territory. It's requiring a lot of legal advice and financial advice to put together the new operational style, new governance arrangements. So things have to be worked through. It's working at quite a pace. Some of your officers here are involved in it. It's a lot of work for the members. It's nice to see so many members here tonight. We've got quite a few of the members from the authority and from the local pension board here tonight. So they know about this, they're hearing about this. It's a lot of work, and it's a lot of extra work for the members in particular to have to pick up. So it may take a little longer to get there, and we're still waiting to get an absolutely firm green light from government that, you know, they've agreed everything and we're ready to go, but we expect to hear anytime soon that's going to be the case. So I'll wind up there and move to the questions that we've got at this point. If I can get to them. There we are. So I've had a number of questions sent in already. And if you don't mind, I'll just sit down at that point. So propose to just run through some of those and answer them. And then if there are any particular other questions related to this part of the presentation, then please feel free to ask them. We'll do our best to answer them. The first two are pretty easy, really. Do we have any guarantee that pooling investments is no? Second one's equally easy. Should local governments stop moaning? Well, yes, it's never a good thing to moan. So that's those two dealt with. No, I'm kidding. On the first one, I think that, I don't know if the question is in the room, so feel free to add anything, but we've no idea. There's nothing being said yet. I mean, having seen an idea of moving towards some sort of pooling, then it's not unreasonable to ask that kind of question. Where might that end up? But at the moment, there's nothing coming from government that lets us know one way or another what their future plans might be. In terms of bringing together pension funds as a complete entity, dealing with both the investments and the administration side, I mean, that would be an enormous task to do. So I wouldn't relish having to handle that one. So the answer is, though, no, we don't know at this point. On Brexit, I think we did say something in one of the bulletins that went out to members about Brexit there, and it's saying, we seem to suggest a decline in business investment, etc. Everybody's entitled to their own view on that. I'm no economist, and even the economists don't agree on what's going to happen with Brexit. So I think the broad answer to Brexit is no one really knows what's going to happen at this stage. We've already seen the Marmite effect. There are worries about inflation. There are worries about the economy moving in a downward direction. So I don't think it's fair to just talk about helping exports, because we also import a lot, and that costs more if sterling's gone down in value. And at the moment, I think we have a trade deficit. So overall, I would have thought if we have a trade deficit, we'd probably do worse rather than better through a devalued pound in the long term. But that's you know, anybody's view on the economics of that. I don't know if anybody wants to pick up any of that. Okay. So on the carbon auditors report, yeah, that's quite a longish question there. I'll have to just refer to my notes on that one, what we've done around that. We've had a carbon audit of our 4 main equity portfolios, which is equivalent to about £2.8 billion, and that was commissioned back in December 2015. And we've had a report which is quite a substantial report. It was a confidential report under the terms of the contract, so we couldn't disclose everything in it, but with some key report findings which show that within our individual equity portfolios across Europe, UK, US and other Far East, they were all more carbon efficient than other relevant sort of benchmark performers. So that suggests that the managers are investing in lower carbon intensive sectors and picking lower intensive stocks within the sectors. The report did identify some approaches that we could continue to do to engage on this sort of general dialogue of encouraging low carbon emissions. And we work closely anyway with the Local Authority Pension Fund Forum, which some of you in the room I know will know about, which seeks to exert appropriate influence on investor groups and individual companies. And we've filed quite a number of issues with shareholder resolutions at AGMs to try to make that point. This is about continuing to work to exercise influence over companies on their attitude to the carbon issues. So I don't propose to say anything more on that unless anybody wants to ask anything more. The Ontario Teachers Pension Plan. This Ontario Teachings comes up in a couple of questions. The Canadian Teachers Pension Fund. It's making 171 billion. The question says. I can't read that. I have to read it from my piece of paper. What's it saying? Yeah, it's making investments from its 171 billion into infrastructure, including infrastructure in this country, in Birmingham. Will we consider making investments in it, in public infrastructure in the north? And what the conditions would need to be satisfied for us to do that? I think, well, we invest anyway on an international basis ourselves. We have investments in infrastructure locally through some limited partnership agreements that we invest in limited partnerships. We're interested in diversification. We would be interested in any good infrastructure opportunities that did come along, but they'd have to justify themselves as good infrastructure investments. We, for example, in the north, we've invested in funds that have an interest in things like Newcastle Airport. We've also made investments in collaboration with other pension funds in other infrastructure activity. In the next few months, we do expect the government to say more, as I was talking about the pooling arrangements, about their plans for local government pension fund infrastructure investments in the UK. And it may be that they certainly talked about looking at creating some kind of central infrastructure fund for the LGPS. It may be that they're prepared to encourage more, or even guarantee, if you like, some of the more risky developments around infrastructure that would take some concerns away from pension funds. So we're quite open to that, as long as there's a good investment case. We wouldn't be disinterested in infrastructure. As I said, we're already active in it anyway. If nobody's interested in developing that question, I'll just move on to the last one.
Just pursuing that one. Sorry, my name's Kevin Swift, but looking at the specific question that says what conditions would be needed to be satisfied for such investments to take place in a way that the interests of current and future pensioners were protected. Now that hits absolutely at the heart of the concerns about the pooling arrangements and the concerns about the facility for government to give guidance on the use of it. Now, how do we, and this is critical, how do we safeguard ourselves against our funds being pushed into the infrastructure investments that the private sector isn't really that interested in? In other words, under government guidance, that our money goes into funds that we might not otherwise have chosen them to be. Now, it's not a totally hypothetical question, and I think that gets to the heart of the question in the penultimate paragraph there.
Right, I see. Well, that sounds to me like a kind of almost political question too, but I'm happy to say something, but Sue might want to comment first.
I'll comment on that because you're right to be worried, and I think all chairs of all the pension funds were worried when the infrastructure was announced, and it was very much seen that this might be a way that government want to prop up infrastructures that the private sector don't. all the chairs that I've spoken to are very, very clear that the first thing the pension fund has to do is make sure that our liabilities are covered, i.e. that we can pay your pensions week in, week out, month in, month out, year in, year out. So very much when ministers and civil servants were talked to, that was stressed over and over again, to the extent that people were saying that if they felt that they were being pushed to invest in something that didn't have a good return, that they would have to look to legal remedies to stop that, because in law it's very, very clear what pension authorities should be doing, and the first and foremost things is the fiduciary duty and the duty to our members. So I think there'd be a big pushback if that becomes not guidance but an absolute direction, and I don't think they'll go there. I don't know whether that helps you in any way or not.
Certainly, I'm very happy with the answer, Chair. I remain apprehensive about the situation that lies behind it. Thank you very much indeed.
Okay, thank you. Thank you, Sue. The last question, in view of Brexit, have you considered moving away from government bonds to real assets in the UK at a broad similar to the Canadian Teachers' Pension Fund? Well, as I said earlier on in the presentation, I touched on some issues around bonds. I mean, they are a real asset for a starter. They are a real asset. Maybe I don't know if the person who put the questions in the room, I mean, they are a real solid asset that you invest in for protection purposes. At the moment, because the yields on bonds aren't great, we're underweight, and we'd maintain that underweight position, and we'd be looking for other forms of investment assets that are likely to give a better return. We already invest abroad anyway, as we said, I showed you in the sort of international spread of the fund's investments. So, you know, there's no change really. We'd consider good investment cases, and what we'll need to do anyway, arising from the actuarial valuation, what we do every 3 years, we'll have another look, working with our actuary, working with the advisors, at the likely liability for the fund moving forward, and how we've got our assets at the moment, and we look particularly with them how we should spread those between growth, between protection, and between income assets. So that will all come under review in any event.
Sorry,
okay.
Since it's my question.
Yeah.
Can I just ask a supplementary one on that?
Yes, of course.
When you go,
Excuse me.
sorry, when you invest abroad, what sort of assistance do you get into going into territories really not known? How do you take guidance? Do you have advisors?
Well, we have advisors we have 3 advisors to the main fund who would come in at the point of considering asset allocation decisions and determining how much exposure we would have in different asset allocation classes, and equally how much of that might be overseas, how much would be in the UK. Then the investment team would always do their very best to do research, intelligence analysis on any potential investments, and in some instances we might put money in funds that are exposed to parts of the world that we wouldn't want to put a huge investment into but take a share of. So we would have monies with funds who might be invested in emerging markets and so on.
And would these be UK-based funds that with headquarters in UK?
Yeah, I think so. I think so. You might be getting into stretching. I joined the fund in July, so real detail I might need to come back to you on rather than.
Okay, thank you.
If you do have a question there of any real detail, do drop me a line and I'll see we'll get a response to you.
Yeah.
Okay.
Thanks.
Okay. So I think that's it for my bit.
Could I go back?
Sure.
Bobbins, I'm a pensioner. Could I go back to sorry, thank you. The number of members that are in the fund,
Yes.
and the diversity that there are. It concerns me that you're going down to Surrey, and it seems that you've said that the reason for taking these partners on is because they tend to have internal management of the fund. I mean, I cannot understand why we haven't gone to West Yorkshire and to 2 or 3 other funds where you would have only had 4 or 5 partners, where it would surely have been much more sensible and the cost would have surely been less if you'd only had 4 or 5 partners than 12 or others at a committee where you've 12 people to argue with. I honestly do not understand why you've gone down this road with partners that are so diverse in the country.
Well, others, I'll pass to others to answer some of that in a moment, because I joined the organisation in July, so some of that history was already in place and well established. But if you remember the slide that I put up, it showed you what the government criteria were. They were looking for scale. They wanted at least 25 billion. So you had the whole country trying to work out who was going to work with who to get those issues around scale and what could work sensibly together. You can see you've got broadly a lot of northern funds in a contiguous boundary, but with a 3 from the south, because they were interested in being, as far as I understand it, in a fund like ours. We've got within it our own South Yorkshire internal team, the Teesside Pension Fund potential internal management team, and also the East Riding. A lot of funds, you see, have very little or no internal management. It's all externally managed through external managers. So people, from my understanding, wanted to buy into something where there was a good internal management focus. I would hope that that would grow over time and be more effective and more efficient than, having funds which were largely externally funded. The specifics of why, we did, who joined in and who didn't, I can't comment on. I don't know if anybody else can.
Perhaps I can say a little bit about it. When we were looking at partners, we did meet up with Manchester and those people. I think what you did was what we did, was you immediately looked to your immediate neighbours, thinking that'll be easier, that'll be regional. We work with them in other spheres, and therefore it might appear that you'd have an easier relationship with them because you're used to them and you know where they are. What became apparent fairly quickly, that actually where you were in the country wasn't the most important thing, but how you approached things, what you wanted from your fund. So we started calling it like-mindedness, people who we thought we'd be able to do business with that would have the same approach as us. And Steve's already talked about, there are some funds that don't do any internal management, none whatsoever. Now, we happen to think that our internal investment team have done a really good job for us. We wanted to be able to access that. We didn't want to go outside all the time. That was very important to us. And it was also important to all our other partners in this, that there was a mixed economy, that you went out when you needed to, but actually you had internal investment. Things like the FCA, we all agreed very quickly once we'd been put together that we wanted to have that registration. We wanted to be able to prove to our members that that we were a quality organisation. I understand that there are still some other of those pools that have not decided that. And that's because they didn't match themselves up at the beginning to what kind of pool they were, what they were comfortable with. Because over the next five years, we're going to have some tricky negotiations. We're not going to agree on anything, but it will help us, and it has already helped us in the first few months of getting together, that we are approaching things in a like-minded way, that we have some things that we agree on. And you've talked about responsible investment. Everybody there is committed to exploring that and leading on a work stream. There are other pools that wouldn't do that. So that's how we got those people. And although there is a geographical, you can see that there are a number geographically that are together, it's why Surrey and odd other people came in. Because actually, when we were doing those exploratory talks, they liked what we were all saying. But at the end of the day, government said 25 billion, and we had to reach 25 billion. So although we were saying that that was our approach, there were some things that government just said, this is what you've got to do, you've got to get to 25 billion, first and foremost. So that was our general approach, and we will see in the coming months, you know, in coming years, how that works out and whether, you know, the people that we're in, we feel comfortable with. But it's been a good start so far, and we've made more progress than a lot of the other pools because of that start. There are also some people in those pools that we work with already on investments, so that there were some people that we knew and we knew we could work well with, and they're in the pool as well. Okay, so I hope that's explained it a bit more.
The one thing that concerned me is that we had one vote on the committee. They used £6 million the same as time, £6 billion the same as time and weight.
Yeah.
But you're taking somebody in that's £1 billion and we're giving them the equal share of the vote.
Yeah, and that is, all pools have done that, one member, one vote. It's so that everybody sits around the table with an equal voice. The bigger members in there, because they will have more staff, more resources, will come with some bigger clout, I suspect. But yeah, it's one member, one vote.
Am I on my own mic? Yes? Good. I hope all that technical hitch has all been about stitching up the new guy. I really do. But we shall see. Yep. No, it wasn't. Okay. Welcome to Barnsley, my hometown, with a slight trace of a Barnsley accent, as always. I feel a bit more at home using it in Barnsley, of course. If you've been before, and I can tell a lot of you have because I've seen you before, you know the drill. I'm going to go through the review of the annual report, looking first of all at our membership numbers. And as always, the numbers are going up. They go up every year because we get more deferreds, we get more retirements during the year that add to the number, and then we have an influx of active members as well. The percentages seem to be going up a little bit more, and there's probably a couple of reasons for that. First of all, overall membership went up by 4.92%, and so we're up to 148,695, and I've used this before, but I'll use it again. It's a good job they all don't come, because we wouldn't have enough chips. So, you know, I mean, but it's nice to see you all anyway. In terms of active members, it seems as if you look at the chart, and I don't know whether you can tell from either your packs or from the screen that those are little people. Don't try counting them because it'll send you daft if you do. But effectively, the active members are going up a bit, which is kind of contrary to what we'd expect, given that we know that the local authorities in the area particularly have been reducing numbers. But we do have something called auto-enrolment, which means that members do have to be brought into the scheme if they're actually employees but not in the scheme, and if they meet certain criteria, then they're brought in. So it does then bring them in, and of course they can opt out again if they wish, but through wanting to be in or just inertia, people actually stay in. And so we see the numbers start to increase a little bit. And if you look at the chart, you can see that from the sort of under 50,000 where we were in 2013, and then we've started to gradually creep back up again. The pensioners and deferreds have gone up, and they've gone up by the most, and I think that again is a sign of the times in relation to the numbers that are retiring, particularly from the district councils, who are the biggest employers in the area, and so those numbers have gone up. I've added a new category on, which is not on the chart, it's not actually in the annual report, but just to show you out of interest how many people actually are exits, i.e. there's no further liability in the fund from within the year. So a bit morbid because it's a mixture of deaths, but also people who have transferred out their benefits or had a refund of contributions. So we've had 1,894 of those throughout the year. This is one that, you know, is trying to gradually get out of the building, this slide, because it's going up and up and up, and has done for a number of years now. And then we're showing it here from 2012, and basically it's the number of employers within the fund. You'll see we're not gathering many more members in terms of that, so all the members are just transferring from one employer to another, and it's mainly due to the academies that are coming out of local education authority control to running things themselves, and when they do that, they have to be themselves as an employer within the fund, have their own contribution rate, administer the scheme like every other employer does, and this is the number that's growing. So we've gone from just under 200 in 2012 to now, at the time we did this report, I can't read my thing, but 369. But looking at it when we wrote the slide, it was 391, and with a further 55 in the pipeline. It's showing no slowing down, that's why it will be going off the page shortly. With 467 employers in total. So we've got the same number of members to deal with, or roughly the same number of members, but we're having to deal with employers, because employers have to administer the scheme, they have to deduct the contributions, they have to deduct the right contributions, they have to pay it over to us, they have to meet our timescales, and of course they don't often do it, or they don't always do it, and that does cause us issues, and the more employers we get, the more issues that we get from them. We try to educate, and we are constantly putting out things. We've got a good electronic system to be able to get information across to them, but nevertheless it is a challenge, particularly with the numbers that we've got now. Performance, Sue mentioned this in her introduction. A few years ago I used to be a bit smug stood here because we were really on top of everything, and we were able to be experiencing 99% more or less during the year in meeting our targets on customer service. And you'll know from previous years, or recall from previous years hopefully, that we put a new system in, and we had no choice, but we put a new system in. It had to go live before we were ready, we had no choice, and things didn't go to plan. Anybody that's experienced IT projects will probably know they tend to run over. Well, we weren't allowed to, we didn't have the choice because we had to be off our old system, and so we went before we were ready, but we went with the best intentions. We then struggled. We struggled with the system, we struggled to get casework out done on time, and as a result the performance fell through the floor, and at our worst we were about 59% on target, which is absolutely hopeless. We gradually getting through that now. We're 2 years in to being live. We went live in October 2 years ago. It's been a real struggle. We're starting to ensure that we get our performance back to where it was in case of meeting the targets. We've not changed the targets, they're still as tough as they always were, but it is slow progress. Looking at the statistics now, we're about 85%, so basically when this was put in the annual report, we've moved on a little bit since then, of course, and that does show that we're gradually getting there in terms of that. If you've ever asked for something during this period and not got what you expected from us, I apologise. Our team have worked amazingly We've had, over the period, we've had the lowest sickness records that we've had in terms of the staff being able to be committed to actually improving and to get back to where they want. And I couldn't do anything, you know, I'd be stood up here with even worse figures if it wasn't for the staff that are actually been so committed to ensuring that despite the struggles they were having with the system when they pressed the button not working or coming up with silly answers and things like that, to persevere and work Saturdays and do everything that they needed to do to get us there. I was at a meeting with the software supplier with our user group in Bradford this week, and it was pleasing in a way to note that yes, we're still hammering them for the things that they still need to do for us, but all were reporting, because there were 8 funds had to do the same as we did, so it weren't just us, we all had to do the same thing at the same time. And they were all reporting that it's been hard, but we're getting there, and I think that's the thing to note really, that we're moving along. The complaints during that period have shot up. Formal complaints are where someone gets to the end of their tether and then they need it dealing with formally. We'll get complaints all the time, and generally that will come into the office, but our staff will deal with those and they will help people, and that's the part of a customer service organisation, which we are, that we want to do. We want to be able to help and be able to solve things for people. And those complaints get dealt with, and they don't hit the formal complaints. The formal complaints is really where no joy can be got at all, and a person decides, right, I need to deal with this formally. So we have a complaints manager, Ian, who will then deal with that and provide a full response to the individuals. So during the year, that was 31. Now, normally we'd have 4 or 5 of those. So, you know, it's an indication of where we were and what I've just told you. Putting it into context against the 67,993 cases that we dealt with during the year, then it ain't many, because, you know, it's 0.04%. But it's 31 too many, but if you like, it isn't that as bad as it actually sounds. And again, going through this year, knowing what we've had since April, those have reduced down even further. So it's a sign that we're getting there. In terms of overall satisfaction, usually this is much higher. It's been a good response from employers, and we get overall satisfaction from surveys we put out. We survey, and you'll know, we survey you because you've got one in your pack. And member satisfaction has fallen to 89%. And I say fallen because 89% doesn't sound too bad, but to be honest, I'd like it much higher, and it has fallen from previous years. But that's what it was at 31st of March. We will just see what this is at 31st of March next year, and then obviously, hopefully it'll bear out where I'm saying that things have improved over the period. We do benchmarking. Benchmarking means comparing ourselves with other like-minded authorities, pension funds. And it's in draft because Sypa, the organisation who deal with it, have had a delay for some reason, and they've not given us the final results. I've seen drafts before. We get a draft every year, and they don't change very much. So basically, I feel comfortable in sharing these with you right now because I don't think they're going to change significantly. Disappointed this year in the number of pension funds taking part. There's 89 LGPS funds in the country. Only 34 have bothered to participate. Usually higher than that. I think a few years ago there was 60 odd and that, and it gives you a better measure of how you're doing, because if there's 50 odd not in there, then clearly we don't know what they're doing. We can suspect they might not be very good, but we don't know. But essentially, it doesn't really help. Having said all that, the cost per member for us, and that's basically how much we spend on you, each individual in this room, for what we do. So we've got our total cost, and then we divide it by the number of members that we've got, and that's how much we spend on each individual person. So how much is the buffet cost? I don't know. But essentially, the indicator that I'm looking at this is basically to make sure that we're below the average. So sometimes it's not good to be below average, but in this instance it is. If you're below average cost, then you're cheaper than the other funds that are in there, and so we're providing our service for a cheaper price. Now that would be okay, but it wouldn't be okay if we were actually rubbish, because obviously we'd have a low price, but we wouldn't be giving you a good service. So effectively, for the 15 quid we were spending on you, we'd be giving you nothing. Well, I like to think we give you a lot more than nothing, and despite what I've just been telling you about our performance statistics, we give you a awful lot besides, and hopefully, you know, things like this event and our newsletters and the way we communicate with you and everything shows that we are a caring authority, we are a customer service organisation. It's borne out by the fact that we get Customer Service Excellence Award. We get it, when we do get it, 100% on each category. So we kind of are high performing but low cost authority, and that's what we like. So it's as I say, it's a shame it's only 34, but out of that we still maintain what we've seen in previous years when more people have been in it. Just a few things that I picked out of there. Oh, and by the way, below average cost 13 out of the 14 years, so it's not just a flash in the pan, we have followed it on as we've been participating in it. So in terms of employers, just a few stats really, just to throw you that. I told you we've got a lot of employers. Well, the 452 in the survey we filled in. The average is 282, which again shows you we're a bigger authority than most. I say it's kind of the Yorkshire in us, because we like as cash. We like as cash close to his chest, I guess. And so when people come to retire, they tend to take the maximum cash option a lot more than the rest of the funds that participate. It's a big difference, that. But that's just the way we are here. And another thing, we look at various staff metrics within the survey, but one, just to give you reassurance, is that we have low turnover. And our staff experience of greater than 15 years is 44% of our staff, whereas the average is 29%. So generally, if you come into pensions in Barnsley, you don't tend to leave until you retire, of course. But again, I think that just illustrates really reassurance that we've got experienced staff dealing with your pensions, and whenever you need us, providing you the answers that you need from us. Okay. 3rd of November coming up will be my 40 years in pensions. And it's been a ride. It's been a long ride, actually. But 40 years in pensions. 4th of November 1976, because I started on 3rd of November 1976, I went to see Thin Lizzy at Sheffield City Hall. And that was my first live gig. And I've liked being on stage ever since. But nevertheless, music is probably my first love aside from pensions. But I started to think, well, if you remember a couple of years ago, I did a Remember in 1976, so I've moved it 20 years now. Some things, 1996 had some grim things, and I'm not going to put them on, but just a couple of things to remind us of what was happening then. Euro 96, another glorious failure. Actually, I suppose it was a little bit better than they have been of late. If you're a football fan, that is. Apologies if you're not. I had to think who the Prime Minister was. I didn't realise it was John Major until I looked him up. Maybe you did. Anybody know why the sheep are in there? Dolly the sheep, yeah, the first cloned mammal. It's a shame we haven't cloned people since, isn't it? You know, things. It hasn't moved on as fast as perhaps people would have thought. But the serious aspect to that is just to compare, and I think I've done this before, so apologies, but it's just trying to just make some more life out of the statistics that we have, and the annual report has statistics in them, and we have to put them in because Sypa guidance says in the annual report you will put statistics, but the thing about the statistics we have on the pension fund is they don't change very much. Year on year, the average age will be pretty much the same as it was and things like that. So if I start telling you the difference between how many men and how many women we've got in the fund, how many are full-time and part-time, remains pretty much the same. So I'm trying to just split it out, and it splits my time in the authority up. So, You know, it's funny because in 1996, I felt like the first 20 years had taken an age. And like the last 20 years are just gone. And it's weird. So maybe it's a sign of getting older, I guess. I mean, everybody says that, don't they? So looking at active members, though, in 1996 we had 31,800. We now got 52,000. Deferred members have shot up. Now, if you think about it, what's happening is when we get to deferreds and pensioners, we're adding to them all the time. And okay, people are dropping off the end, but we're always adding to them. And they've shot up to 51,000. Pensioner members, 47,000 now as opposed to 21,000. So total members now from 1996 was 63,000 to 150,000. These is as of today, 150,000 members. So an awful lot more members. The fund assets, Steve's been talking about the pension fund, and this is at 31st of March. 1.2 billion in 1996, 6.25 billion. Now 1.2 to 6.5 don't sound a lot, but when it's billions, it's a lot. It's a big amount of money. The funding level, at least it's in the right direction. It probably hasn't moved as far as we would all like it to. But 80% in 1996, and it's been lower than that because I think if you saw the last valuation, we were 76%. But we were now at 85% on the current fund results. Employer contributions, that's had an effect. That's changed fairly significantly. An average, because of obviously different employers have different amounts, but 10.7 in 1996 was the average. Currently, 14.8 plus an extra £67 million a year on top of. So that's a significant amount more contributions. We've talked about employers, 75 active employers against 391 now. And something just to put that into context is the number of staff. There were 51 of us in 1996 dealing with 63,000 members, and now there's 55 of us dealing with 150,000 members. So big difference in numbers, but not a big difference in staff. So just something just to commemorate my 40 years. It was 0 last year, and I had bad news. This year, it's 1%. If you're looking at your pack, it said 0.6 because when I had to do the slide and get it ready for printing, I only had August's. And usually it doesn't change much from August to September anyway. So I was on a fairly easy win. I would have thought that it weren't going to be much different, but it is. So your increase from April, you will be getting an increase if you're on pension or you're deferred member, and it'll be 1%. Thought I would just give you a bit of a chart on that, and not dwell too much on it, but basically that's how pensions increase has gone over the last few years. We put this in the annual report, so I've tried to just put that there for you. So you can see that it's been bigger in the past, but at least it's better than 0. In terms of current issues, I tend to just give you a flavour of what's majorly on our radar at the moment. But when I looked back at what I'd said last year, I thought, I better recap on them because, to be honest, we were predicting certain things might happen that didn't happen and things like that. So the bit in the box really is the current issues from last year. We're talking about freedom and choice and the fact that we thought we might have a fair amount of work to do with that. I've got a question on that, so I'll come on to that on the next slide. End of contracting out has caused us some extra work. We've partnered with another organisation to help us do that because of all the work that we had, and that's still ongoing. Pension taxation, we figured, and it was very much rumoured that George Osborne would change the way of pensions tax relief works, and that might affect us all in some ways if you're actually still paying into the scheme. Well, George is no longer in his job, and he didn't actually do it in the end either, and we're not quite sure whether this will actually come in or not in the future. The government seem to be going in a slightly different direction with it, but we'll obviously need to wait and see. Public sector exit pay cap was due from 1st of October, and that's been delayed, and that could be delayed indefinitely, which has helped employers who are dealing with restructuring and redundancy exercises, because the exit cap would have affected their ability to push these things through. So that's not really had any impact as we thought it might. What we are dealing with now is the actuarial valuation. Steve mentioned that. We're pretty much well on the way with that. We've had discussions with the district councils. We are at the point where we will get the individual employer results, and that's when the fund starts. That's when I start writing to them and telling them that they've got to pay extra money from April, and that's when they start not liking me. And so we end up with discussions and so on. And of course, with more employers, I have more letters to send and so on. So my phone will be ringing quite a lot, I'm sure. But that's targeted for early November. And the process runs through pretty much into the new year when the authority finally will sign off the valuation. And then it's a case of then trying to make sure when we get to April that they do pay us the new amounts of money that they're asking for. Within the admin team, we're clearing backlogs. We talked about the performance, and certainly that's an issue for us. We've been through a cycle. If you're a current scheme member, you will have had an annual statement from us this year. The annual statement needs to be out by 31st of August. It's an insane timescale, but it's statutory. We have to abide by it, and we did, but we did it at a cost. We succeeded at that, but the cost was that work then got left. Now, we don't just leave any work. It's lower priority stuff, but it's work nevertheless. And we're concentrating on clearing those. And at the back of all that is I'm actually looking at reviewing the way that we work and the way that we operate in the office to try and ensure that we don't get into these situations again, that we use the system that we've got in the most effective way, we use our staff in the most effective way, to ensure that we continue to provide you with the service that you deserve. I've had a few questions. First of all, a gentleman sent me a question about, which is really personal to him. So if he's in the audience, and I don't want to mention his name or anything just in case he is, but it's about converting pension to a once and for all lump sum. He's just come and see me at the end, but I don't really need to speak about your own personal details in front of everybody else. But in terms of the questions that I can repeat on here, first about a question from a female scheme member who's asking, are the benefits for for beneficiaries of female members the same as for males? The fact is they are, so the scheme is fully equal now, but it's only in respect of membership from April 88. So if you were a female paying into the scheme, and you're now on pension, if you have got a husband or a partner and you retired after April 88, then he will get a pension based only on the membership from 88. So if you've got 20 years or 30 years before 88, then it wouldn't count on that. It would only count on the bit after April 88. If you'd retired before 88, then your husband or partner would get nothing. So that's just important to know, and I think that question's born out of the fact that people may be thinking that there are benefits payable when there might not be as much as they think, or there might even be zeros. It's all in our booklets and so on that we put out there and everything, but the question's been asked, so I just wanted to make that clear. In relation to what I was saying from the other page about freedom and choice, I've had the question, have we been adversely affected by the pension freedom legislation? The answer is no. We've had very few. We've had some, and a few members have transferred their benefits out of the scheme into a vehicle to then commute it. And there is sometimes good reason for that. People who may have got a limited life expectancy or something like that, where paying a pension over the next 30 years is no use to them. They want the money now, and if our scheme can't give them the money now, in that sense, then who's to say they can't just take their money and do what they want with it? But ordinarily, it's got to the point perhaps where independent advisors, because you have to have independent advice before you can take your money, it's got to the point where independent advisors get involved and then they don't tend to transfer. The scheme's due to change from April. We've got some draft legislation as well, which actually does open up early payment of benefits for people 55 and over who left before April 14. People who have been in the scheme since April 14 have that as right now. So I'm over 55, I could just go and retire. It's at my cost though, because my pension will be reduced. So it's my choice as to whether I want to take the reduction and go, and if I wanted to go badly enough I could, or if I looked at it and said, no, that's too much a reduction, then I could work on, and the longer I work on, the bigger my benefits get. People who'd left before April 14, so I've got a deferred benefit, didn't have that right. They will now be given that, and so people like that, who when they turn 55 can come along to us and say, can I have my benefits? And we will show them what the benefits are, and if they want to take them, that they can. So those were the questions that I had pre-submitted. Has anybody got any questions for me? Either anything that I've said or anything to do with pensions admin?
On the death benefits, I thought you, prior to that, there was I paid an extra 1% so that my wife would get a 50% rather than the third.
Yeah.
Is that the same thing that we're talking about, or is that a different?
It's a different thing. It's similar. I mean, that question was focused really on female scheme members. The scheme in the 70s was pretty much male-orientated, or written for the career male, if you like, because it doesn't sound good saying it today, but in those days it was about, if you were a female in the scheme and you died, that was it. Whereas if you were a man, then widow's benefits were payable. What you're talking about is pre-72 membership, and prior to 72 you had a deduction from your lump sum to fund your widow's benefits. So you would have paid extra contributions to avoid having that reduction from your lump sum. Okay. Anybody else? Okay, well that's me. Thank you very much.
I think we like refreshments, and I do hope there's chips there since Gary's talked about chips. I think they're due about 7 o'clock, so we actually have got time for the quiz, which is just a bit of fun. So we'll have the quiz and then we'll have light refreshments. But maybe I'll just say we would really appreciate if you give us your feedback. There's something in the pack for you to do that. We take it very seriously. We do try and change things if we can as a result of what you say. There's myself and the officers here and some members that are on the board that I'm sure over chips would be, very welcome to come and approach us, to have a chat with us, ask us anything. If there's something you haven't wanted to ask in the questions personally to you, and we can't give you the answers tonight, we will come back to you. So enjoy the quiz and enjoy the light refreshments and chips, I hope.
Right. So I'm just wondering, is that all the questions visible up there? Don't think it is. No. Can you reduce the size of the text? Get them all on one page, or no? Okay, don't worry. Well, there's a second page, isn't there, with some questions on, I think. Right. So we'll give a minute on couple of minutes on the first page, a few minutes on the first page, and then flick to the second page. All right. So the kind of questions that we try to make a bit related to investments and things of that nature, if you want to have a go at answering them. Once you've had a few minutes on that, we'll move to the second page and then we'll show you the answers. Might be a slightly different format. I don't know what we did last year.
Well, you could always read them out and ask the questions.
All right then.
Yeah, and ask for the answers.
Okay then. Who knows the answer to number 1 then? 24? How many? Anybody disagree with 24? 24 is the right answer.
Well done, Ben.
Number 2 is a good one, though.
Read it out.
What drug was first commercialized by Bayer in 1898 as a painkiller and cough suppressant? Paracetamol, ibuprofen, heroin, or Benadryl? How many for Benadryl? And how many for heroin? Well, it is in fact heroin. Don't know whether any of you are actual users, but it's, that was the right answer. Yeah. Number 3, which is the world's largest producer of microchips? The US, China, Taiwan, or Korea? Korea? How many for Korea? Anybody for anywhere else? China? How many for China? Korea was the correct answer. Which car did Frederick Porsche design? Volkswagen, BMW, Audi, Mini, or Mercedes? Somebody's saying Mercedes. How many for Mercedes? And how many for VW? Yes, VW. Volkswagen Technik, I think. Right, what countries... I practiced that earlier today with Fiona, actually, on a different issue, sorry. We're trying to get some money out of them, aren't we? What countries are known under the acronym of BRICS, B-R-I-C-S?
Say again, Ken.
Brazil, Russia, India, and China.
One other. What's the S stand for? Sorry? That's right, it is. It's Brazil, Russia, India, China, and South Africa. Well done. Where was paper money first used? Rome, Greece, India, 7th century China, or Roman Britain? Nobody's going for anything but China. Correct, yeah. What was the first country to give women the vote? Oh, sorry, which country was the first country to give women the vote? Well, everybody knows that one. Well done. And when? 1823, 1893, 1913, or 1933? Well done. 1893.
We've got somebody who does pub quizzing.
Exactly. Well, I had no idea. When did someone say, inventions have reached their limit and I see no hope for further developments? 100 BC, 10 AD, 1850, or 1950? 1850? Anybody for anything different? Apparently, it was a Roman engineer in 10 AD. Who? I didn't get any of these right, I can assure you, apart from, I think, the first one I think I got. Who said, assume that our company will go to zero in 10 years. Find me several new business models to replace it. Was it John Harvey Jones, Jack Welch, Larry Page, or Bill Gates? It was, in fact, Larry Page of Google. And what is Britain's largest port by value for goods exported outside the EU? Tilbury, Liverpool, Heathrow, or Southampton? Yeah, I thought it was a bit of a trick question, that one, actually. Heathrow it is, yes, correct.
Sypa.
Yeah, Heathrow. I didn't sort of think... I suppose it's a port, I suppose. Which company president said he thought there was a world market for maybe 5 computers? Oh, we didn't put any choices up there, did we? Oh, sorry. It was, and do you know the name? It was IBM, it was Tom Watson. I thought he was a golfer. Which 2 cities have driverless cars operating taxi services today? Yeah. Gary insisted on that one going in. Pittsburgh, London, Singapore, Barnsley, New York, or Barcelona? Singapore is one of them. Is that what you're saying, Singapore? Who's for Singapore? Yeah, that's one of them. Zurich, did you say? That's not on the list, is it?
Yeah, it is.
Oh, I added that in after, just to make it, just because I thought somebody might go for that one. Yeah, no. It's actually Pittsburgh, yeah. Yeah, sorry. And that's the last one now, isn't it? According to the Independent, the town of Acciaroli, if that's how you pronounce it, in Italy, has the highest concentration of centenarians in Europe at 10%. As well as a healthy diet, a high consumption of which herb is thought to be a possible contributory factor? Is it basil, oregano, parsley, or rosemary? I can't hear what you're saying there. Which one are you going for?
Basil. We've had basil.
Who's going for oregano? Anybody going for anything else? Basil. So it's oregano, basil. In fact, according to this, it's rosemary. So, well, there you go. That's it. That's it. Thank you.
Well, that couldn't have been more perfectly timed. Thank you so much, because we're at 7 o'clock. So thank you all for coming. We really appreciate you coming. We appreciate you, the manner in which you ask your questions as well. And as I say, we are here to answer any while we take refreshments. So thank you, and have a safe journey home as well. Thank you.